In this video, we're going to delve into the world of index funds, which can be a less risky way to invest than putting all your money into a single business. If you are not sure what investing is, then I would strongly recommend you stop now and instead watch this video up here that explains in the most basic way possible what it means to invest. You can always come back to this video afterwards. Now, for a beginner investor, index funds can be an excellent starting point to grow your money steadily over time without having to worry about picking individual stocks. But first, what exactly is an index fund? The word fund just means a pot of money, like your retirement fund or the money in a fundraiser. And an index is just like what you find at the start of a book, a list of contents and chapters. An investment index is a list of companies that belong to a given fund. And there are a few famous ones you may or may not have heard of. The FTSE 100, the S&P 500, NASDAQ, and so on. Let's take the S&P 500. This is an index of the top 500 companies that trade on one of the United States' largest stock markets. So the index is the list of companies and the fund is the pot of money that has been invested in those companies. What makes these index funds good things to invest in? Well, if you were to look at the S&P 500, you might see companies such as Apple, Microsoft, Amazon, as well as Johnson & Johnson, ExxonMobil, or MasterCard. Now, you could, as an investor, choose one of these companies and decide to invest in them. Many people do just this. But there is a risk, however unlikely it may seem today, that any one of these companies could go out of business. And in doing so, they would take your investment with them. Even if that doesn't happen, they could start to perform poorly, lose their share of the market to other companies, and the value of their company could drop, and you could, again, lose money. So how can you avoid this? Well, instead of investing in just one or two of the companies, you invest in all of them. But how on earth could anyone ever afford to buy shares in all of the top 500 companies in the US? Well, that is what index funds are for. For as little as £100, you can invest in an index fund that tracks the S&P 500. And your £100 will be spread across all the companies within that fund. Now, you wouldn't be able to get whole shares for your £100. You would instead have a small fraction of one share for each company. And this is what the index fund facilitates. They allow you to invest in micro shares of all the companies within the fund. And there is one specific way you can do this that allows you to not pay any tax on any of the gains that you make. That's right, tax-free money. But before we get to that, we need to understand why spreading your investment across multiple companies is a good thing. Because your money is invested in all the companies in the index fund, it matters a lot less if any one or even some of them fail or lose value, because there are plenty of other companies in the fund that could be doing well and will balance out your losses. So if you're thinking now of the phrase, don't keep all your eggs in one basket, well, you would be right. Where eggs are your money and the basket is a company. You spread your money across multiple baskets, so if any one fails, well, then you don't lose everything. But there are other factors at play. Whole economies can go up and down, and this can affect the whole fund. And there are times when the whole stock market is down, and in rare cases, can even crash. So if you had, for example, put £100 in the S&P 500 in 2007, well, you would have lost half of your money within 1 year in the ensuing financial crisis of 2008. Sounds scary, and it is for people going through it. But there is one last piece of information that we need to understand about index funds and the S&P 500 in particular. Performance over time. Despite the big crashes we have seen in the past and will likely see again in the future, the overwhelming trajectory of the S&P 500 in particular is upward. So after the crash comes the recovery. And over time, we can see that on average, the S&P 500 has grown by around 11.8% per year. And if you watch my previous video on the basics of investing, you might remember that inflation is the thing that makes our money lose value over time. And it's currently running at around 7.9%, which, by the way, is very high compared to the last 10 years, where it has usually been below 2%. So the S&P 500 and other index funds seem to be a good place to put your money, as an average return of 11.8% easily beats the rate of inflation. So how then can you invest in an index fund? By far, the easiest and most efficient way to do it is through a stocks and shares ISA. And this is the method I talked about earlier that will allow you to keep your profit without paying any tax at all. And to understand what these are and how to get one, well, then you need to watch this video here, where I'll explain in detail for a complete beginner what they are, how they work, and how you can set one up for yourself. Now, all that's left to do is to press like and subscribe because, well, the video is over.